You're listening to the Reinvest Podcast, where each Tuesday we show business owners and entrepreneurs how to reclaim, reconnect, and refocus their life by bringing you the top real estate professionals in the industry. We'll help you diversify into real estate by equipping you with the tools and tactics to build generational wealth. Your hosts, Garrett Gatton and Seth Ciminillo. Hey guys, thanks for jumping on to another episode of the Reinvest Podcast. Just a couple of housekeeping things. Please, if you've found benefit from this show, share it with somebody new. Help us continue to kind of grow our exposure that way as we bring all things commercial real estate to you guys, just to kind of keep you on the current trends of what's happening in commercial real estate, strategies to stay on that. And additionally, we're Level 5 Capital is our investment company. And so if you want to visit the show notes, click on our link, go kick the tires on our website. Let us know what your thoughts are on that, as we're going to use that to communicate just future investment opportunities. And then we'll also have a link for you to be a part of our monthly newsletter called The Huddle. So make sure you click on that as well if you want to be a part of it. But we have a great guest and episode lined up for us today. And we're going to talk about something that is rapidly changing in the commercial real estate kind of scene. And with us today is Micha Mattox. Micah, I wanted to say Greg Mattox because of our off-screen conversation about the Atlanta Braves. But you're not Greg Mattox, but you are an Atlanta Braves fan. You're in Atlanta, Georgia. Give us a little synopsis. Who is Micha Mattox, the man, the myth, the legend?
Absolutely. Absolutely. And first of all, thank you all for having me today. Really excited for what we have in store today. So my name is Micha Mattox. I work with Real Protect, who is a real estate investment insurance company. So that's 100% of what we do is insurance for real estate investors. Pretty broad as a class, and we've got different groups that handle a lot of different classes. Most of what I handle and work on day to day is multifamily. So we've done this now for about 15 years, gotten to meet a lot of great, incredible people, and just really immersed ourselves in the industry. Real estate is so tight knit, as I'm sure you all very well know. And we've just gotten to really, dig in and dive in, to meet a lot of people and do a lot of great things. So, in a nutshell, so I'm a father of two. We live here in Atlanta. So, got a full plate between the day job and the kids, of course. But
man, I'm telling you, one kid will keep you busy. So we were talking on a podcast. It would have been the previous week's podcast. Our guest had 10 kids. And admittedly, though, he said that the biggest jump is from 0 to 1, which I think that's true as well. Putting that parent hat on for the first time is a big deal. But you've got 2 young kids. How long have you been doing insurance on the commercial side of things?
So we've been doing it for about 15 years now.
Okay.
So before that, did some personal insurance. I actually got my start at State Farm, a name that everybody knows.
Yeah.
Did home and car insurance. So very different world than what we're looking at today. But yeah, insurance is a really dynamic industry that I've been blessed to be a part of. So
you're kind of you're in a space, commercial insurance, specifically multifamily. It's been a really happening sector of commercial real estate in the last 5 to 7 years. And it's really not just been one narrative. It has been through a lot of ups, and now we're seeing some things kind of shake. So excited to get your thoughts on what's happening in this landscape. But to kick us off, talk about how commercial insurance, what did that look like pre-COVID, okay?
mhm.
And then maybe walk us through a chronological timeline over the last 3-ish years.
Absolutely. So to set the scene, I'm going to take it back a little bit further than 3. I'm going to go back to 10, just because it really sets the scene for kind of what's happened. 10 years ago is really when things began to be challenged. When you look at the commercial insurance market as a whole, pardon me, very specific to property owners and things like that. So around 10 years ago, we started seeing trends where the claims that a lot of these carriers were paying out were more than the money they were bringing in. Usually that's a very easy translation to a real estate investor, because I can say, hey, if you bought a deal and you lost money year over year over year, what would you call that? Well, that's a really bad investment. You're gonna want to run, not walk, and get away from that as quickly as you can. So like I said, if we take ourselves back about 10 years, that's when the trouble really began to start. Over the course of 10 years, from around 2013 to around 2023, each year the money that was lost, aka the claims that were paid out, got to be a larger and larger deficit between the carriers, the money they were bringing in versus what they were paying out.
What were the
Um,
factors to that?
yeah. So geographically, you're going to see different things in different areas. We can use a case study on a state like Florida. We'll pick on them for a second. Geography there is the number one thing. So again, if you're going to be having hurricanes, experiencing catastrophic weather events and things like that, we noticed, and the data shows that not only the frequency of those issues, the number of hurricanes that come in any given season, but also the severity of each one began to grow greater and greater. A lot of controversy or opinion around really what brought that. Is that climate change? Is that a number of other things that brought that on, or are these just historical weather patterns that we're going through a rough patch right now? Time will tell with regard to that. Pretty soon we're going to notice, okay, this is here to stay, or no, it's getting better, and it was just a part of a rough cycle that we had to make our way through. So, again, if you take a geography of a state like Florida, that's pretty common. Fun fact, I'll pick on Florida again. Around 70% of insurance fraud in the U.S. occurs in Florida. And a lot of people
I heard that the other day.
Yeah.
Somebody was telling me. So
Why
what's
is
up
that?
with Florida?
Yeah. Is it just because it's such low-hanging fruit because there are so many catastrophic events, people can just kind of like damage their own property in the midst of that and say, hey.
Yeah, what kind of fraud's happening there?
Yeah. So sometimes it's more kind of base level like that. Something's wrong with the roof, and maybe an owner says, hey, I'm going to go ahead and call it roof damage or whatever, just to make up a scenario. So some of it's that. A lot of it's more sophisticated. So in Florida, there's what's called assignment of benefits. The ABA process. So, or AOB rather. So assignment of benefits is where, as an owner, you may say, hey, I've purchased this policy. Maybe a catastrophic event happens. So what happens is a team will come engage with you. Oftentimes it's a contractor, a public adjuster, and an attorney, and they work in tandem there. So what'll happen is, the contractor comes out and says, hey, we noticed a little bit of damage. We think you've got, reason for a claim. Maybe you've got something going on. So they go back to the insurance company and say, hey, we went out and investigated. It looks like it's going to be, I'll make up a number, it's going to be $500,000 to fix all the roofs across, let's say it's a multifamily complex. So the carrier says, hey, we also sent somebody out. We looked at it. It really doesn't look like damage. Maybe there's a couple shingles that need to be replaced, but, it's not quite that catastrophic. So then in steps the public adjuster. So the public adjuster comes in and says, hey, I know you've been talking to the contractor, but actually we think it's probably about double that. I know we said $500,000, but it really looks more like $1 million now that we're really laying eyes on it. In which case the insurance carrier says, hey guys, we're getting further and further apart here. Something's off. So then, they may say, hey, we're not willing to pay for that because we don't believe it was caused, or, whatever the case is. So then in steps the attorney. So the attorney comes in and says, hey, I know we said $1 million was our last number. It's looking more like 2 million probably looks like a better number at this point. Now that we've
What kind of
really,
shingles
really
are these they're putting on?
It's heavy duty shingles. It's we've got to fly the guys in to come put them on. The whole 9 yards. So and all of that, of course, is overall hyperbole. But all of that to say, what's happening is you're seeing these claims that are probably not going to be that severe get to where it's more and more severe. More and more conflated, whatever the case is. When situations like that happen, and low hanging fruit, it's probably a good term to assign to that, just because damage is so common that anything that comes up can kind of follow that route. But again, what you're watching happen through that translation is that claim should have been $50,000. And then again, it's never going to settle for 2 million, but it's some number much, much more than 50,000.
Wow.
And that's where we're seeing this deficit. In 2022, that's the last data that I've seen. For every dollar that carriers were paid in premium, they paid out over $2 in claims.
Oh my gosh.
Again, just it's an unsustainable business model.
Was that in Florida specifically, or just everywhere?
That's in Florida specifically. Nationwide, it's a little over $1, so it's still a loss, but not quite as severe.
Wow.
So let me ask you this question. So historically, insurance companies are some of the most well-capitalized businesses and companies in the world. I mean, like they'll loan out low interest rate money because they can do it. Right. Kind of the back end of that is they have to be able to keep so much money on their books to meet in the event of a loss. Right. Is that? Can you explain that?
Yeah. So oftentimes a carrier, when they're regulated by the state or, however they're organized, depending on what that looks like. So they're often going to be required to have certain levels of capitalization based on that, based on, the probable amount of claims they could have, based on the amount of policies they have. There's this whole matrix that would go through to determine what that number looks like. It used to be, and just like you said, it used to be that surplus was a lot greater and they had extra money and we can invest, we can loan out, we can go do different things. And I wouldn't say that stopped entirely because it certainly hasn't. But it's just not quite what it used to be. The insurance marketplace of 10 years ago very much was that. A lot of that has been constrained just because of this. They're having to make sure and really, really watch this. Not that they weren't watching it closely, but watching it much more closely just because they're watching these claims come in, they're watching these events happen one after the other, and there's a lot of data out there that's really interesting. This could easily be a 4 or 5 hour conversation, but all of that to say they're watching, these claims come in and they're saying, okay, we've got to really make sure, if something were to happen, we've got that money on hand. Another component of that is reinsurance. Not sure if you all are familiar. Reinsurance is really just insurance for an insurance company.
Who insures the insurance company?
Exactly. So to pick on a common name that everybody knows, we'll say Travelers. So let's say that you own a multifamily complex and you go buy a policy for $10 million worth of coverage, just to make nice round numbers. So Travelers is going to go around and say, hey, we're going to try to offload half of this risk or whatever number they ascertain is good. They're going to say, hey, we're going to offload some of this risk to somebody else. That way, if a claim comes in, we're not going to have, we're not going to eat the whole thing, basically. So they may say, if you pay $100,000 for that $10 million in coverage, of that premium, they may go out and offload $5 million and pay a reinsurer for that. It is, gross oversimplification, but that's how it works. So it's been common to do that, and that's always been a component of it. As a consumer of insurance, you would really never know that component's there because, again, your promise, your contract is with the carrier, Travelers in this case. So you would really never know it's there. In the event of a claim, it really doesn't matter for you because you're getting your check from Travelers. But that is a really big back-end system. What changed was on 1/1 of 2023, north of 60% of the available reinsurance in the marketplace disappeared overnight. And that's, again, after 10 years of them losing money. And eventually, and this is, the story goes that it was a, backdoor meeting, and all of them got together and said, hey, guys, we can't do this anymore. We've given it 10 years for the market to work itself out, and it just hasn't happened. And we've got to exit for a little bit and try to figure out what's going on. And that's exactly what happened.
Wow.
So we watch.
I'm sorry, just because you're blowing my mind with this stuff. These reinsurance companies, which probably the public would not really know the names of these companies or recognize them.
Not typically. And there's a lot of groups that invest in reinsurance that they would know, the Morgan Stanleys of the world, the BlackRocks, whoever else. So a lot of common names that people would recognize, not that they would know the reinsurer specifically, but yes.
So 60% or the market share, 60% of the market share of these companies said overnight collectively, we are no longer going to provide this. Mm-hmm. And so now what that means is, and I'm making the connections, you tell me if this is the right or wrong connection. Now the carriers have to bear the full liability of those insurance policies they normally would subsidize or share that exposure with a reinsurance company.
100%.
And so now they're either not writing those policies anymore,
or they're charging more money,
or they're pricing in risk.
See, you really didn't even need me. You're already drawing all the conclusions correctly.
Well,
no, that's exactly right. That's exactly what happened. And that was, to kick off 2023. Last year was the roughest or most expensive, however you would look at it. The hardest insurance market for property since 1986.
So
was 2023.
This is so fascinating because, we try to stay really plugged in on the real estate investment kind of buzz and what's going on. Everybody sees as the property owner that you're getting quoted more insurance, and you're like, that sounds exorbitant. Why is that? And you hear the geographical stuff. Hey, insurance companies are pulling out of Florida, natural disaster. People don't understand that when a national carrier has a loss in this geographic region, it affects their policies across the board because they have to recoup that loss and disperse it across their coverage areas, right? So we all knew that, but nobody was talking about the reinsurance companies pulling back.
And it's something that a lot of people, wouldn't know it. I wouldn't say it's, it's not hidden knowledge per se, just it's something you wouldn't know unless you really, really dug in and knew where to look and you were connected with those groups. So
for one of my properties, in 2023, the insurance costs went up 25%.
And that was probably a low number compared to a lot of what we saw in the marketplace.
From year to year. It just went up 25% for no reason, same coverage.
And I'm going to go ahead and go out on a limb here. Your deductible probably went up. You probably got a little less coverage, and it went up 25%.
And these poor insurance guys, these insurance brokers, right? They're kind of on the front line. So, if you don't understand this and you're listening, an insurance broker doesn't write policies for one coverage, one carrier. They represent, multiple to price it out and give you the best terms. So imagine being the point person that represents 15 different insurance companies, and each one of those companies is changing their internal policies. And then you have to go communicate that to your end consumer, the client, because you're the middleman between those insurance carriers and the property owner. I mean, who would want to be in insurance right now?
Last year was a long year. Yeah. Well, and to kind of put a number to that. So, an independent broker, they're going to have a certain number of markets they can go to, markets and carriers. We're a little bit over 400 is our market reach across the U.S. And some of those are state specific, some of those are regional, some of those are national. But again, even more so, 15 would have been a great number to have. 400 was a lot. Yeah.
Now on the other side of that, though, it gives you guys the ability to play ball with some of those companies that maybe didn't have their eggs in one basket or weren't so adversely affected by some of these events.
Well, and the difficulty last year was, that there were probably 5 or 6 major factors. The reinsurance, that was definitely the most tangible and then the largest effect, but there were a couple of other factors. So, for example, replacement cost. So it used to be 10 years ago, let's say if you have a typical garden style frame, multifamily complex, it used to be $60 to $80 a square foot was what you would insure that for. Most carriers are now pushing for somewhere north of $100, $125 a square foot. And again, your insurance is rated based off the total amount of insurance. So again, the more you raise that up, the more your premium goes up. There was a shortage in materials, and that was a part of the pre or not pre-COVID, but during COVID and post-COVID environment. A shortage of skilled labor. There were just a ton of these factors that honestly just converged, and last year was the ultimate result of that. So that's kind of the bad news. The good news, we can kind of lead off on a positive note now. So as of 1/1 of 2024, all of that reinsurance capital re-entered the marketplace with about a 30% surplus. What we're watching happen now is a lot of these carriers, it used to be last year, you couldn't get an underwriter interested, so like you said, a person in our position, let's say we talk, you guys say, hey, we've got this property, we're looking at it, or, we own it, whatever the case is. It was hard last year to get underwriters interested just because they were all kind of locked down, so to speak, last year. That the opposite is true now. We're actually able to go out. Carriers and underwriters are coming to the table ready to make deals. That they have the ability to make deals. We're heading into a much more dynamic marketplace. Not to say it's going to get fixed overnight. That would be a far stretch. It would be great, but it's just not going to happen. But at least we're seeing some positive trends. To where we're headed in the right direction. That reinsurance capital has come back into play. A lot of the other ancillary factors, so the shortage of skilled labor, shortage of materials, a lot of that has kind of sorted itself out. So again, we're kind of in a, we're not what I would call a softening market, but we have plateaued versus what we saw last year.
So you don't think necessarily insurance costs are going to go down, but maybe they're not going to keep increasing at the rate that we've seen it the last couple of years?
Well, so a lot of that depends on the geography again. Pardon me. So, in those areas where they saw, again, we'll pick on Florida one more time. Why not? So, in Florida last year, let's say their insurance cost, instead of going up 25%, let's say it went up 100%, because that was a very real scenario for a lot of owners in Florida. So if it went up 100%, now that the market is settling back down some, there is some room to cut out of. So all of that to say, in Texas and Florida, places like that, there are some renewals that we're delivering this year that are at a decrease. So that there is ability to decrease premiums. It depends on a lot of factors, I guess, is the number one thing I would boil that down to. Is every asset is unique, in what it experienced, how it's insured, all those things. That there are some cases where we're still able to go down in rate. Are we ever going to get back to the rates of 5 years ago? No, it's not going to happen. Right. Kind of like lending rates, once they go up, they're up for a while, so
there's a cycle.
It's not going back overnight. But again, if it goes down, if it's not going up and maybe it goes down 5% a year, that's still a much better outlook than what we had.
Right.
Mike, I want to ask you kind of your perspective on, so I mean, obviously most of the time that a client of yours calls you, they have a property in mind usually, and they want you to give them a quote on insurance coverage for that type of property. But let's just have, like, you are on the front lines of pricing insurance quotes for a myriad of different types of multifamily assets. What are the observations that you've seen of what assets would be appealing from an insurance perspective, and you would say don't touch with a 10-foot pole?
So that's a really good question, and one that we actually get pretty often. So in the marketplace, I would say there's nothing that is, or at least for the most part, there's not a lot of properties that are uninsurable, but there are some properties that are going to be more costly or, have more restrictive terms than others. I know in the value add multifamily space, something that we're seeing a lot is, you're looking at that 60s, 70s, 80s vintage product, especially here in the Southeast, we'll say. Oftentimes it's going to have claims. There's, kind of a running joke, and joke's not a good word for it, but a running, observation in the insurance industry in the Southeast is if you have a multifamily complex, it's going to have a shooting and it's going to have a fire, at least one of each. And it's true, unfortunately.
That's funny.
Well, yeah. It's
kind of, but
funny
not.
and
Yeah.
Yeah, we're on the same page. All of that to say, it depends on a lot of factors, but those
So
properties.
let me pause you real quick. You said something that I think maybe gone over my head or someone else's head. So you said it may have had claims. You're saying that like past claims on a property, even though you're the prospective owner, is going to affect because those claims stick with the property.
100%, 100%. Yeah. So it's very much situational. So for example, and I mean, I can use a story from this morning. So we've got a gentleman buying a property, and I think it was about 2.5 years ago. It had about a $2 million fire. We got all the details.
Wow.
It was a tenant that unfortunately was behind on the rent, was not happy about it, and caused an incident. And believe it or
Why
not,
would you
that's the story
set
we
fire
hear.
to an apartment complex, people? I mean, like a single family home, I get it,
Yeah.
but like, wow.
Yeah. And believe it or not, we hear that all the time. I mean, that's not the first one this month that that we've heard of.
You're seeing the best of
more common than
humanity,
usual.
aren't you?
Yeah. So all of that to say, so that was about 2 years ago. So we got the story, and the new owner, his sentiment is, what could I have done there? I didn't own the property at that time. I didn't control that tenant. Everything's been fixed since then. We've gone through and, screened all the tenants, and, we've really made sure to turn over the tenant base to where it is, where we want it to be. Why should I be penalized there? And ultimately, you're exactly right. It follows the asset for a certain number of years. Now, with that said, if we can come in with a good story and say, hey, here's exactly what happened. It was a tenant, that caused it. It wasn't a structural issue. There was no electrical component that was bad or an appliance that was bad or anything like that. It was a disgruntled tenant. It was X amount of time ago. Here's the measures that have been put in place to correct it. If we can really tell that story, it's going to affect it more minimally than if it's, something that's more recent or, maybe it was an electrical issue and the property's got bad wiring. That one's kind of hard to overcome because every other underwriter that sees that, they're going to have that flashback like, okay,
Right.
no.
Yeah.
So all of that to say, it is very situational, but a lot of it comes down to just, what story can we tell? What happened? How can we frame this to be in a positive light on how we're correcting it moving forward and things like that.
If somebody calls you and says, hey, Micah, I've got a property I'm looking at, and what they're asking is give me a quote to insure this property, do you proactively tell them if you see a claim on your end, or should they ask you specifically, hey, can you tell me if there's ever been any claims on this property that would adversely affect insuring it?
So that's a really good question. So if you were to go buy homeowners insurance for your house, let's just say, so if you were to go buy homeowners insurance, you call your personal insurance agent, we'll say it's a State Farm or whoever, you're going to call them up and say, hey, I'm looking at the property 1234 Main Street, I'm going to buy it next month for me and my family. They can run a report that shows you the historical claims on that property. That does not exist in the multifamily or commercial space.
Holy cow. So, how do you tell?
It's a bit of an antiquated process. So each carrier develops what are called loss runs, loss history. So the seller would need to provide you with a copy of that for the last 3 years, 4 years, 5 years, whatever that is. And hopefully they had insurance and hopefully they can provide them and so on and so forth. That is where we get that data from, is oftentimes from the seller, or not oftentimes, it's 100%.
From their existing carrier that's in place at the time of purchasing it.
That's
So
correct. That's correct.
that's a due diligence item that's on the buyer to get from the seller, and they're asking for, what is the report called?
Loss runs or loss history. Yep.
From their insurance carrier to see if
Yeah.
there's been claims.
And that's probably the number one thing I would ask for. So the day that you have an LOI, it gets accepted, you're under due diligence. First thing you need to ask for, can I have a copy of the loss runs? Because that's going to tell you immediately, again, that there are some other outliers, not to say there aren't other problems that could come up. That's the biggest thing that we see where it's just a smack in the face is everything looks awesome. And the last step of the process, they get loss runs. Well, yeah, there was a fire a year ago. It was $3 million and, XYZ happened, or there was two shootings last month, or,
They're like,
whatever
but
the
it was
case
no big
was.
deal.
And they're like, holy crap, I had no idea. Nobody told me about this. So,
Well, because
again,
it kind of forces the seller to provide a level of transparency you might not get up front. And if a seller can't provide that, that's a little sketchy.
Yeah. Well, and not only that, but again, I think for an owner, that helps you to better understand the property. So if you look at those loss runs, loss history, whatever you want to call it, if you look at that and maybe there's been a fire once a year for the past 3 years, something's wrong. Something is wrong with the property.
Yeah, right.
And then you can at least, know about that and factor that into your process. Maybe it's something you can overcome. Maybe it's just, bad luck and a series of unfortunate events, but, maybe there is an underlying issue. Maybe the wiring's bad, or maybe the appliances malfunctioned, or, whatever the case was. So again, being able to look at that, helps you to begin to understand the property too. Was it a one-off incident? Is there a pattern here? Because I'm going to go through the same thing. And again, that plays into a number of things. Is your insurance cost going to go up next year when you have a fire?
Right.
People are taking larger and larger deductibles to try to offset cost right now. So let's say you're an owner that says, hey, my bank's okay with a $250,000 deductible. Well, you're on the hook for that money. So again, if you have a fire this time next year and it's statistically likely for that property to have one based on its history. Again, that's just all things that you need to consider to make sure that you know what you're getting into and, that you can sustain it.
So here's kind of the $1 million question. Are you seeing investors change their investment strategies based on the insurance costs or the markets that these properties are located in?
Sometimes. Oftentimes when somebody is serious about a certain market, they have at least a working understanding of what the insurance looks like. Some of that conversation happens before we get together. Some of it happens, in our initial conversations. Ultimately, yes. I think it does influence that, and that, frankly, it would be hard for it not to, at least to some degree, influence that in some way. I think the biggest factor for a lot of owners, and I'll sidebar right here. So, we engage in two main ways. Way number one is that we go to the marketplaces, we get full quotes. It's underwritten. Underwriters and carriers look at it. It's a fully bindable quote. The other thing that we do is called an indication. So what we've done is right now we insure a little north of 500,000 doors across the U.S. and all different states.
Wow.
We've taken that data and we've plugged it into a program, Microsoft Power BI. I don't know if you love the Microsoft suite, but very, very awesome, powerful program. So what we've done is we plugged all that data in for each property, the quotes they have, the rates they have. So in about 5 minutes, if you call me up today and said, hey, Micah, I'm looking at an 80s vintage product in Austin, Texas, this many units, and just give me the high level data, we can run it through that program and I can say, okay, your rate's going to be around this. Again, it's not spot on. It's not perfect, but it's a quick 5-minute look. And we call that an indication. So all of that to say, a lot of people are utilizing that on the front end. The biggest kind of, I hate to keep saying smack in the face, but the biggest smack in the face that a lot of investors and owners see is where they estimate the insurance to be here, and then somebody goes out to the marketplace, and then suddenly it's there. It doubles, or it's 50% more than they thought it would be. The biggest way around that we found is if we can give some kind of indication data on the front end, which, to be fair, a lot of assumptions are made, but it's as perfect as it can be, for an imperfect process.
Right.
At least having that number as a baseline helps to establish, okay, here's the reality of what you're looking at. And then later on during the process, when we go to these carriers, they at least kind of know what they're looking at. And typically we're within about 10% of that final number. So it's pretty well dialed in.
Wow. Wow. That's fascinating.
Yeah.
I think you've given us a high level view of what's been happening, some of the things that people have been seeing or sensing and feeling, but kind of the backstory behind it. And then even from a due diligence process, how should you as an existing owner treat insurance and what questions to ask, or even looking at a prospective property. So that's super tangible.
We're going to jump into our, go ahead. Did you have something to add to that?
The last point I was going to add there was, even if you're selling a property, so if you're at a disposition stage, that's important as well. And if you can provide that, that's going to help them to kind of speed that process along as well.
Right.
That's a way that you can say, hey, we want to speed along this transaction. The more that you can have in your file that you give to them, or give to any prospective buyer that's looking, the more that's going to help, because that's honestly a great thing. If you can say, hey guys, here's all the loss runs. As you can see, they're totally clean. We've got no issues, no claims. That's going to be a big check mark in your favor.
This has got a clean Carfax report, so you should buy it. Yep.
Yeah.
100%.
All right. We're going to jump into our smaller pockets segment. So Micah, go ahead and tell us about your worst real estate deal. It could be something you were part of personally, or maybe insurance claim or something that went wrong. What happened?
I bet you've got a good one.
And then what did you learn from it, even from, the side of the table that you were on?
Yeah. So I did not a deal that I was invested in or had any money in, but just from working on the insurance side of things. And a lot of this goes hand in hand with kind of what we were just discussing. So I would say some of the biggest, or if I had to pick one, the biggest, kind of pitfall that I've seen is an investor, I'm trying to figure out the wording here, misestimating, if you will, or misanticipating, what their insurance cost is going to be. We had one incident in Florida. It was actually in South Florida, and it was a gentleman that came to us very late in the process. They had already come through due diligence. They were, just about to close, and they had, insurance trouble with the current agent that was helping them. The other agent told them, hey, we looked at everything. It looks like a pretty decent property. And mind you, this is in South Florida, in Tri-County. And they said, hey, yeah, we're estimating the insurance to be somewhere around $700 to $800 a door.
Okay.
Going rate in that area is probably $2,000 to $3,000 on a good day.
Wow. I was like, we estimate for like $600 a door here in Northwest Ohio. Mm-hmm. So that sounds like a great deal.
Yeah. So you add in some hurricanes, and then yeah. So all of that to say, that we ended up working through the deal. Everything ended up working out, but it was a very, very tough process. And then that was, in the thick of it last year when insurance was as bad as it was.
So they still closed on it despite they're like a third of what they should have been.
So the positives were that this was a group who was very well capitalized. So they had some money to move around. Secondarily, there was some room in the deal to where some other expenses were able to be cut to kind of make this work. We ended up getting called in a few favors, ended up getting the insurance at under $2,000 a door. I think it was around $1,650, somewhere in there. So again, over double what they were initially projecting, but certainly better than what it could have been. But
for sure,
again, that's right off the top, that's probably one of the worst that we've seen, that we had to really hop in and do everything we could to try to make the situation okay again.
I thought you were going to tell a story where you're like, we had a property where there was a shooting and then the shooter set fire to the property, kind of based on what you said happens earlier, but no double whammy there.
Then I was going to say, yeah, if we want stories like that, have more than enough. We had, so we actually had this happen. It was about 1.5 years ago here in the Southeast. I won't name where, here in the Southeast, where a property was purchased, and around 3 months later, the night before Thanksgiving, a mother, but unfortunately had 2 twins, ended up killing one of the twins, and then set the building on fire with the other twin inside.
What? Wow, that's crazy.
So, we see the good and the bad, and then some of those things, heartbreaking, come across our desk, and we're there to step in and, of course, make everything as right as it can be.
So on a personal level, I mean, like, how are you brought into a situation like that? Are you the person they call? Do you send the adjuster out? Like, how are you involved in a process like that?
So in that scenario, I'm the first call. And then that's how it needs to be, just to gain understanding of, okay, what happened. And, that situation took a little while to develop, of course, but, something more minor, you have a little water leak and maybe not that big of a deal. Call me on Monday,
Right.
But, something like that needs to be an immediate phone call, and it's, I think it was around 11 p.m. that night before Thanksgiving. And I'm on the phone scrambling, getting with carriers and, initiating that process, but, it's something like that needs immediate handling. Just, for natural reasons, of course. But there's a lot of things that are more minor, and then it's actually interesting. There's a lot of things we don't know about until we get the report. There's things that are more minor that happen that people don't call us on. They go right to the carrier or work through a contractor, whatever the case is, and sometimes we find out later in the process, or at renewal, we'll receive a copy of those loss runs, and then it's like, oh, okay, wow, there was a big claim. What happened? But most of the time we do end up finding out. They do end up telling us. So.
Wow. Like a good neighbor, Micah is there. I don't know if I can say that, but
yeah, it's probably copyright.
copyrighted.
Yeah, probably copyright.
Strike that.
You're getting him sued.
All right, we're going to go into what we call our little nugget. So, Micah, this is the part of our show where you give our listeners a practical takeaway or maybe a very tried and true principle as it relates to real estate investing.
So from an insurance perspective, I think the biggest thing that you can do as an owner investor to help yourself is just to understand the process. Speaking with somebody who does know, the back end, okay, here's what's going on, here's where the future is, here are the reasons that this is happening. I'm the same way as a consumer. If I call, pick a vendor, whoever, if I call somebody and say, hey, had this situation happen, what's going on? And they say, oh yeah, well, costs are up, inflation, things like that. Well, I hope you have a great day. As a consumer, that's not going to sit well with me. And I think the same is true. I know the same is true, with a lot of investors where they're just not getting a lot of data. They're not getting information, that they know what's going on. They hear about it. They can see it. They see their premiums going up, but they don't really know what's going on. Again, so number one, just a general understanding or a good resource that you can go to really understand those things. But I think that helps in all aspects of how you interact with insurance. Everybody has to have it, especially on a lot of these real estate deals, where there's debt involved, especially, you're going to have insurance, not only have it, but have it to a certain standard the lender's okay with and things like that. The more that you can understand that process, the more you can use it to your advantage and begin to have that edge on others who don't understand it. Right now, insurance is top 2 or top 3, one of the top 2 or top 3 expenses at any given property. You throw in taxes and a few others, but it's right up there with the rest of them. So being able to understand that process, to understand, okay, what are my options to reduce cost, things like that helps deals to be within reach that maybe aren't for others that don't understand the process. So if you can take some time and build your network, get with a good group of people who understand how this works, you really, really begin to set yourself apart, because again, some of those deals that wouldn't have worked, well, maybe something they don't, and then now you can make it work.
So while you were talking, it kind of populated in my mind. What separates like a good insurance agent from a mediocre or bad one? Because there's good realtors, okay, that know their stuff, and then there's just bad realtors that are just bopping around. Sure, they'll help you, they'll sell you anything, but you're not getting the same level of service or outcome. So how does that equate to the insurance realm? Because there are just a plethora of insurance agents out there. Just all sorts of insurance agents for residential, for commercial. I bet there's in our small town, there's 6 different State Farm branches. You know what I mean? They're just all crammed around. So what's kind of some of those defining factors from you personally that you've seen, or maybe that you've seen in others?
Yeah. Well, I would say one of the ones, I've got 2 really big ones. I'll share those next. One of the big points is making sure you're working with somebody who has access to the whole marketplace. That seems to be a really, really big, just recurring theme that we've seen, of course. So, the downside to working with what we would call a captive agency, so Farmers, Allstate, groups like that, they've got one bullet. They have their one company, and if the quote works, that's great. And if it doesn't, they really don't have anything else, anywhere else to go to. If the rate goes up next year, so on and so forth. There's a lot of positive with that model, but one of the big drawbacks that we've seen is you're just not quite as flexible as some of the other groups that can go out to the entire marketplace, for example. I would say the 2 biggest things are communication and knowledge, in addition to that one piece that I just shared. At a high level, being able to not only communicate but articulate, okay, here's what's going on, here's what you need, here's why you need it, having expertise to communicate with the lender, things like that. Communication is ultimately the biggest piece, and I would say that's in any industry. If you don't pick up the phone, if you can't answer your email, and then the second piece comes in, which is the knowledge. If you can't pair those 2 things together, it's going to be a rough ride. And unfortunately, we do hear some stories about that. But I think in our space, if you can find somebody who communicates well, communicates quickly, and then just, has the knowledge to guide you through the process. That's why you have an insurance agent, and why you don't go try to buy insurance directly from a carrier, is I need somebody on my side. I need somebody who knows what's going on, who knows all the factors that maybe I'm going to miss as a real estate investor. My day job is finding good deals, buying and operating those deals. It's not insurance for most. So again, being with somebody that can communicate and that knows what's going on, it seems to make a world of difference.
Micah, what's been one of the best resources in your professional career?
LinkedIn.
Oh, really?
LinkedIn, hands down.
Connecting with people, getting leads through LinkedIn.
Well, and I would actually say it's on both sides. I would say building relationships with carriers and building relationships with, our prospective customers, with owners. Insurance is relational in the exact same way that real estate is. There are underwriters that we can call just because we've been working with them and we have that track record, and maybe we can get stuff done that others can't, because they know who we are. They know, hey, I went out to dinner with Micah. I hear from him all the time. We interact on LinkedIn. That there is still that relationship, and LinkedIn is just such a good incubator for those relationships. And
Full
oftentimes
transparency,
they go outside of
I think
LinkedIn.
I found you off of LinkedIn.
I think so. Yeah. See, that's how good it is.
Oh my gosh. That's awesome.
It's a great incubator for those relationships on both sides. And then same thing, we have a newsletter we put out and some things like that. And it's all just educational content. Here's what's going on. Yeah. Here's what you can anticipate. Here's some strategies, just any way that we can help. And unfortunately, we found in the insurance space, the bar is often set pretty low. For a lot of folks that just don't feel like they're getting what they want to get out of it. And that looks like different things, but they don't feel like what they're getting is what they want. So again, the bar is set pretty low, we found, but being able just to go in and say, hey, here's what's going on. Here's how we operate. Maybe here's some strategies you haven't thought about. Oftentimes it's a very easy conversation starter.
Well, and I think the stereotype for insurance is they try to grab new business and then set you on renewals, right? And that's kind of the business model. And so finding somebody who's going to continue to stay engaged with you on an ongoing basis is a way to set yourself apart. But what would it look like for people to connect with you and follow your success?
Let me guess, LinkedIn.
You beat me to it.
He's like TikTok. No,
that's a new one. We haven't tried TikTok yet, but LinkedIn's great. Through our website, through LinkedIn, a lot of places like that. We don't really do a lot elsewhere other than that. At least in the online presence space, we haven't really gotten into Facebook and Instagram and things like that. But yeah, LinkedIn's a great place. It's got, our emails, newsletters, you name it. It's got all the good stuff on there. And ultimately, what's going to help most is, just a conversation, and we try to be extremely available. And I think my Calendly's on LinkedIn as well to come and grab a quick meeting and just kind of talk through the situation, whatever it is. But yeah, LinkedIn's a great spot.
Well, guys, if you're listening, Micah knows his stuff, and go talk some insurance with him. I'm sure he'll do that. We will put those things in our show notes. Dude, thank you for taking time today to kind of unfold something that a lot of people are affected by, but don't give a lot of thought to. So.
Absolutely. No, it's been a great conversation and really enjoyed being here. So no, thank you guys for having me.
Awesome. As always, excited that you joined us for another episode of the Reinvest Podcast. Stay tuned every Tuesday for new episodes. And if you want to learn how you can use your hard-earned capital to diversify into real estate, go to our website, lv5capital.com, and shoot us a message. Move farther, reach higher, and grow deeper. We'll see you next time.